Hello and welcome to the Pilot Money Podcast. My name is Alex Tapia, President and Founder of Aviation Retirement Strategies and ARS Private Wealth. Together, we give you the tools and advice you need to take advantage of the ever-changing financial world and help you take care of the business end of your professional aviation career. As financial fiduciaries, we bring you up-to-date, relevant, and independent information so that you can make sound financial decisions for yourself, your family, and your eventual retirement from the airlines. Don't forget to hit the subscribe button so that you can stay up to date on any timely information that we bring to the professional aviation community. Or you can also visit us online at www.pilotmoney.com. Once again, welcome to the Pilot Money Podcast. Okay, let's talk about the big one, the one that generates the most questions and has for many, many years. This is something that a lot of folks actually do not fully understand, and it's really not as difficult as they make it out to be, because there's a lot of talk out there about, what this is, how it changes, what it's going to be, how it's calculated, and all those kinds of things. And it just really creates a lot of confusion. But if you understand the basics of what a pension plan is, it's really not that complicated. It's actually fairly easy to understand if you understand the basic concept behind it. And that's what I'm going to explain to you right now. So your CARP option, which stands for Continental Airlines Retirement Plan, is basically what we consider an A plan, or is considered a basic pension plan. And pension plans were initially initiated way back a long time ago when you had companies like AT&T and Bell South, where the people that work for them were promised a lifetime payment upon retirement if they gave so many years to the company during their working years. And when they retired, obviously, they got a lifetime payment of, whatever the amount, whatever it was, but they could basically count on these payments, and they're guaranteed for the rest of their lives. And they also have the option to attach beneficiaries so that if they pass away, maybe the spouse or kids or whatever can continue getting payments. And that's also an option. It's called the survivorship option. But basically, it's a pension plan. And the CARP is really no different than the old school pension plans, but it has a couple of features that some don't have, and actually a very, very good feature, which is a lump sum option. Now, many people believe that the lump sums in the pension plans are part of the pension plan, and actually, they're really not. Your CARP has really nothing to do with a lump sum. It's simply just an option that was negotiated into the contract, so that to give you an extra benefit or an extra option when you do decide to retire. And this is basically how it works. A pension plan is a promise for a company to give you a certain payment based on certain amount of years work, they call them service credits, based on however long you've worked for a certain company. They're required to give you a certain amount of money per month. And everything is based on a monthly annuity, not yearly nor anything like that, but essentially based on a monthly payment that the company has to give you. And the thing with the pension plan, it's very, very attractive for a company to have one, or at least it used to be, to actually have one, because it also gives them lots of tax benefits and lots of benefits that the company can use that helps their bottom line a little bit. Most importantly, it is a retention tool to take an employee and make sure, or at least fairly positive, that they're going to stay with you a very, very long time. And for doing so, they reward them by giving them a lifetime payment that they can count on. Well, one of the arguments is, well, we're in the airline industry. Things are not that stable, and that's very, very true. And that's a very, very great point. So that's a consideration to take when you're taking a lifetime payment. But most pension plans, that's really the only option that you have. You can, when you retire, you can either take your lifetime payment based on your own life, or you can add a survivorship annuity, which is meaning you attach a beneficiary, and then you can, that when you pass away, that your spouse can continue getting the payments. That's what most traditional pension plans have for their employees. Now, the CARP is a little bit special, and by that meaning that they offer a lump sum option. And this is really where the confusion comes from. So what is this lump sum? How is it calculated? And how is it different from an annuity? Well, basically, a lump sum payment is basically the company saying, I'm going to give you one payment, and then we're done with our obligation to you, and you can do whatever it is that you want with that money. So, which is great. It's not a bad thing to do. You have control, and it gives you a lot of advantages. But what is it, and how is it calculated? Because the pension has nothing to do with a lump sum. So here's basically where it comes from. The company when you retire, what they do is they're working with the IRS, and they're trying to figure out, how much money they need to set aside for you in order to pay you for the rest of your life. And something that's really interesting that I've always found, for some reason, the IRS knows how much, or knows when you're going to die. So they have this all calculated. They've got these tables, and we've got these obscure people they called actuaries, and they calculate all this stuff based on risk, and they figure out when this person's going to die statistically. Well, let's assume that you're going to retire at 65, and let's say that you work for 30 years, which is, by the way, when the CARB maxes out, it maxes out at 30 years. It doesn't grow anymore based on the amount of years of service that you give the company. So 30 years max. So let's assume that you have 30 years, and you are 65 years old, and the company goes to the IRS. Okay, well, this person's retiring. How long is this person going to live? And the IRS will tell them, well, they're going to live here 20 years. So you need to make sure that you have whatever the monthly payment is for this person, that you make sure that you have to have enough money in the account to provide them with that benefit for the next 20 years. Okay. And here's basically kind of how the math works. So let's talk about the lump sum in generic broker. So based on the amount is based on various factors. It is based on a monthly annuity, like I said, and is based on your eligible years of service. Some other things, but that's one of the main considerations when calculating how much your pension is going to be. And it also depends on interest rates. Okay. And when I say interest rates, I mean the interest rate that the government sets for the company to be able to invest your money so that they can, grow the money to a certain extent to make sure that they have 20 years of payments for you. If you guys remember, for those of you that have CARP, you probably do. If you remember, there used to be a term been thrown around called the GAT rate. Okay, and the GAT rate, it used to be what was the name for the interest rate that the pension plan used to use to calculate your payments, or calculate how much money the company had to set aside for you when you retired. Now, the GAT rate stands for the General Agreement of Trade and Tariff, and it's basically the 30-year Treasury bond yield rate for the government, meaning it's a very stable rate. So when you retire, or when they were using it when you retired, the government told the company, okay, well, you can take the money and invest it at this rate for however long, and that's the interest that they used to use. Now, the way it works is this. It's from a calculation standpoint. The hypothetical. Let's assume that you retire with at 65 with $3,000 a month for a lifetime payment. And the IRS actuarial tables, they say that you're going to live somewhere around 20 years. So basically going to be going to 85 years old. Okay. So what they do is they take $3,000 and they multiply times 12, which is $36,000 a year, which makes it, if you multiply that by 20 years, the company is required to come up with $720,000 when you retire, to make sure that you have those payments. And let me say this as well. If the company does not come up with the right amount of money, there can be severe consequences for them from a tax standpoint. The tax deductibility of their pension plan, they can be taken away. So it's extremely crucial that the company comes up with this money. But the IRS also realizes that the $720,000 in this example is not necessarily what the company has to come up with on day one, because they have 20 years to come up with this number. So what the interest rates are all about, and what the GAT rate used to be, it used to say, well, we know that you have to come up in this example with $720,000 over a course of 20 years. So in order for you to make sure that you can do that, we will allow you to invest a certain amount of money at a certain interest rate, and we can do the calculations, whatever that money is with that interest rate, so long as it adds up to $720,000 by the end of the 20-year period, then you are good to go. So in other words, the company will take, let's say that the interest rate is about 5%. And I believe they'll have that. Let's say it at an interest rate at about 5%. And by the way, let me back up. They don't use GAT rate anymore. They changed the calculations for the pension plans, I think somewhere around 2006, 2007. And they now use what's called a composite corporate bond rate, or the CCBR rate, which is a rate which is generally a little bit higher than the government rate because it's based on corporations. It's a little bit more volatile, so not as secure, but secure enough to be considered for a pension plan. So they're a little bit higher. So let's assume that the CCBR, the corporate bond rate today, is 5%. So what the company has to do is they have to figure out, okay, to get $720,000 over a 20-year period, what do I have to invest today at 5% in order to get there? And basically, what they're going to come up with is they're going to come up with $448,640. And they're going to say, if you invest that amount at 5% over a 20-year period, you're going to meet your obligation of $720,000. So what the company did when they negotiated, and I believe it was Gordon Bethune that got this done, and which is an amazing thing because it's an extremely good benefit compared to other pension plans. They said, you know what? If the IRS is forcing us to come up with that money anyway on day one, why don't we just give it to the employee and let them do whatever they want? They can put it into an IRA, they can invest it, that gives you more control, at least give you another option. So that is actually what the lump sum option is. So if you think about the interest rate, if the interest rates are high, let's say that they're 7%. Well, if the company's getting a better return on their money, they can invest less money initially in order to get to that $720,000 number in 20 years, meaning that the lump sum, or the amount that they have to come up with, is a lot less. Conversely, if the interest rate is really, really low, they have to come up with a lot more money in order to get to the $720,000 by the end of 20 years, meaning that the lump sum is going to go up. So when you see the lump sums going up and down, when you go to your benefits resources and you type in the parameters, and sometimes they're significantly different, it depends on the interest rate at which the company has to invest your money at. And that is your lump sum. And that is the only reason, or the primary reason, why it varies as much as it does. Now, there are some other reasons why it can potentially vary, but it also depends on your years of service, the best 5 years of your last 10 years, the best 5 consecutive years of your last 10 years in terms of pay, in the interest rates, and basically those are the primary parameters in which the lump sum varies from time to time. Now, what's important to also understand about your lump sum when you're calculating it is that they calculate it twice a year. So basically, every 6 month period, uh, it constantly changes because they use the corporate bond rate, which is published monthly by the IRS. They use the rate of either February or August, and whatever that rate is, that's what they use as a calculation. So if you calculate your lump sum out maybe 3, 4, 5 years in the future, it's not going to be very accurate because they're using projections of interest rates, what they think that they're going to be, but it's not really realistic in terms of what is really going to be. And interest rates are fairly volatile if you look at them from a globe from a far away. So they do constantly change. So, but if you're within a 6 month period and you project out your lump sum benefit, it's going to be pretty accurate because they know the interest rates that they're going to be using. And by that time, they also know what your best 5 out of 10 is going to be. So the calculation is a little bit more accurate. So some of you might ask, well, why would I take a lump sum versus the annuity? Right. Well, there's advantages and disadvantages to both. And it's important to understand the differences so that you can make an informed decision. Now, if you need help making that decision, we can help you walk through the numbers and the math behind it. But basically, this is what they are from a broad perspective. Now, one of the benefits of taking a lump sum versus a pension or a guaranteed lifetime monthly income is you have greater control over your assets, meaning you're going to get a large chunk of money that you can invest and you can do whatever you want with, so that you basically have control over what it is that you do and how you take it. Most importantly, you can decide how to invest it and potentially make more money with it in the market rather than just getting a monthly income stream that is never going to go up or down. It's just going to always be whatever it is going to be from the start. So it gives you greater control of your assets and greater control over setting up your foundational asset structure when you begin cash flowing your retirement assets so that you can live off of them. The next one is you have a potential, and I say potential because it's not always guaranteed, it's a potential for higher, longer term returns. You can make more money. And that's basically, something that most people are trying to do, to try to make the most of what they can. But taking a lump sum option, if structured properly and invested properly, it gives you potential for higher, longer term returns. It also gives you flexibility, because with flexibility, with a heavy lump sum of cash, you can do whatever it is that you want. You can put it into an IRA. You can cash it out. You can pay taxes on it if you want to. I wouldn't suggest it, but it's something that you can do. You can make sure that it passes on to beneficiaries, something that a pension payment doesn't necessarily have, or at least is very restricted in that sense. So it gives you also more flexibility. It gives you estate planning advantages. If it is important for you to leave something to somebody, like loved ones, like kids, your dog, your cat, whatever it may be, this is what's going to allow you to do that. Where the pension payment, the guaranteed income stream, is very restricted when it comes to estate planning or passing assets on to loved ones or beneficiary or whatever is important to you. And also, one of the things that is probably the most important part, and one of the key deciding factor for taking a lump sum versus an annuity, is the fact that you have potentially an inflation protection. When you take an annuity, it is a fixed payment, and for the rest of your life, it is not going to change. Well, everybody knows that inflation is always present in the background, and it increases every single year. So every single year that you're taking an annuity payment, the value of that payment, even though it's the same, the value of that payment is going to be going down and down in each and every year. And if inflation happens to go up pretty significantly, that payment can be significantly be devalued, meaning that you can buy less with it. The buying power of it is going to be devalued. When it's invested in the market, there's ways to protect yourself against inflation using certain vehicles and just market growth as well. So the inflation protection is something that is paramount in making the decision as to whether you want to take the annuity or whether you want to take the lump sum. Tax planning opportunities, with a lump sum, you can control when you take the money. You can put it into an IRA, because highly suggest that you do this. In fact, a lot of people don't do this. They take the lump sum from the CARP and they roll it into a checking account, meaning that they're going to automatically be taxed at the highest rate. It's like taking let's say your lump sum is $300,000. It's like having a $300,000 income as far as the IRS is concerned, and they're going to tax you accordingly. Now, if you roll it into an IRA, which is what we highly suggest that to do, and that's what we do with every single one of our clients, you have the flexibility of taking the money as you need it. And there's certain things that we do as professional financial planners. We can time your distribution so that it can have the least tax effect on your current year, which is highly desirable, because who wants to pay taxes? One of the main things that we do is to try to get you away from having to pay the taxes that you don't need to pay at any given point in time. So having the lump sum also gives you tax planning opportunities that you otherwise would not necessarily have. And also, um, you know, personally, having worked for an airline, I know how volatile they are. Many of you have been working for the airline for so long, you understand exactly what I'm saying, and you know what I'm talking about. Airlines are not exactly stable. Now, I would say that United, out of all of the airlines, is probably one of the most stable airlines that are out there, but that doesn't necessarily mean that you have 100% safety working for an airline. Anything can happen. What happened to me, for instance, after 9/11, completely unexpected, but it turned this world inside and out, or rather upside down. And that can always happen. And if your pension is tied to the success and the health of an airline, well, potentially that could be a negative thing, because you don't know what's going to happen. So taking the lump sum completely separates you from the health of the airline, and basically puts all the balls in your court, and you have full control over your assets, regardless of what's happening to United Airlines. And lastly, you have liquidity. When you have a liquidity event, when you need money for a roof, and you have health expenses, or you want to give money to a grandchild, or whatever it is that may be, giving that liquidity by having the lump sum is the only way that you're going to get it. Because if you take the annuity, the only option that you have is to get that monthly payment, which is fixed for the rest of your life. So not necessarily that much flexibility in that. Where you take the lump sum, you have liquidity availability from all the cash that you have, and you can do whatever it is that you want with it. Now, there could be potential tax consequences of taking a bunch of money out, but we can work through that together. But at least it gives you that option should you ever need some liquidity in case of an emergency, or just anything that can happen in life. Okay, let's talk about some of the trade-offs for taking a lump sum because it's not all good things because there are certain things that you are risks that you are inheriting by taking a lump sum. And it's important, I'm going to preface before we go into that, to speak to a financial planner, a professional financial planner, not a salesperson selling annuities or mutual funds, or a professional financial planner that knows what they're doing, that can strategize for you to mitigate, hopefully as much as possible, the risks that you're taking by having a lump sum in your account, which is usually a large chunk of cash. One of the first risks that you have to deal with is investment risk. Markets go up and down. There's very few people that have enough money to just stuff under their pillow and call it a day and just take withdrawals from it and pay taxes on it and have a certain amount of certainty that they're not going to outlive their money. So it requires for most people, it requires investing in the markets, and there's always investment risk because markets always go up and down. So it's important to keep that in mind and plan accordingly if you choose to take a lump sum. One of the most damaging thing that can happen to any portfolio is the sequence of return risk. And what that means is that just like when you go flying, when pilots go, when pilots they take the runway, when you guys are taking off, you're planning for all of the worst case scenarios. You're a financial person, or if you're doing it yourself, you should be thinking about all the potential negative scenarios that can happen to you, because at any given point in time, the market will surprise you and they could potentially go in a negative way. The worst thing that can happen to you is when the day that you retire and shortly thereafter the market comes crashing down, and then your account is probably going to come along with it. And that is something that is probably the biggest risk that we as financial planners, we try to mitigate as much as possible. We plan for this actually every single day, but not everybody does. And if that were to happen to you, it can be extremely detrimental to the long-term performance and success of your retirement. The next one is obviously the possibility of outliving your assets if your withdrawals are too high, if your expenses are too much to based on the amount of money that you have. You might run out of money before you pass away, meaning that you're going to be able to have to live maybe on Social Security or drastically cut back, and some potential negative effects or consequences that are going to happen with that. So one of the biggest risks that are out there is potentially living out outliving your assets, which basically also comes with the next one, which is by taking the lump sum from the CARP, you are guaranteeing that you will not have a guaranteed lifetime income stream from the pension plan, because you have basically deleted that option once you take the lump sum. And also, you know, investing money at any level requires a disciplined approach. And this is, again, why it's so crucial to talk to a financial planner, to talk to somebody, a professional who can guide you in making the right investment choices in a disciplined fashion, so that you can hopefully give yourself the best statistical probability of not outliving your assets, to be able to grow your assets, to account for inflation, unexpected living expenses, and all these types of things that you have to worry about when you are in retirement. So when you are trying to make the decision, keep these things in mind because they are a risk, and try to mitigate these risks before you ever make a decision, so that if something does happen, any of these actually do happen to you, at the very least you're prepared for it, and the effects of it will be minimal at the very least.